Hi Rachel, I'm going to go over a couple of things here this is chapter 9 when calculating the allowance account. So the first thing I want to point out is that when you're doing anything that has to do with sales, so percent of sales, whatever amount you calculate is the amount of your adjusting entry. And this is an adjusting entry, so it's just like we did in chapter 3, where adjusting entries have to follow the two rules. Right? No cash, and you'll either debit an expense or credit a revenue. In this case, we're debiting the expense, bad debts expense. So they give us all the information. Credit sales is $322. We want 2% of credit sales. Accounts receivable is $36,000. We use the allowance method. Journalize the bad debts expense using the percent of sales. So if it's a percent of sales, our credit sales is $322. We want 2% of that. Oops, sorry, you can't see that. So 2% is $6,440. That is the amount of our adjusting entry. So when we do our adjusting entry, this is on 31. The adjusting entry, no matter what method we're doing, is always going to be a debit to bad debts expense and a credit to the allowance account. The amount that we calculated was $6,440. And that's all we need. So the amount that we calculated is the amount of our adjusting entry. This entry follows the two rules, so that's great. I'm all good. Part 2 says show how accounts receivable will be reported on the balance sheet. Okay. Now, on the balance sheet, we start with assets, and then we have current assets, and then we have cash, and then we'll have accounts receivable. And we will say less whatever is in the balance of our allowance account. Accounts receivable has a balance of $36,000. Okay. The allowance account only has this $6,440 in it. That needs to be in parentheses. And then we draw a line because we're going to do math. We're going to do the 36,000 minus the 6,440. Our net realizable is 29,560. That's going to go to the right, 29,560. It's not going underneath because this is a separate column from this. The book does not explain it very well. But here's what's happening. Above here, I have cash. And down here, I have, I don't know, supplies. Cash is 10,000. Supplies is 500. Right? So this is the actual column for what my asset that I'm adding. This column is indented because I'm doing subtraction. Right? So just like when we had our our truck minus accumulated depreciation, we had to indent that, and then the net value, the book value of the truck, would go over here. It's the same thing because this is a contra asset. It's attached to the allowance account. I like that when I learned this, this account was not called allowance for bad debt. It was called allowance for doubtful account receivable. And then oh, it's attached to account receivable. I don't know, they changed it. It's fine. Okay, so this was 6. 7 is not percent of sales. It's a percent of receivables. Anytime it's a percent of receivables or aging of anything that has to do with receivable, the amount that you calculate needs to be the ending balance in your allowance account. So this one says we've got 18,000 in our account receivable account. We earned $447. We collected $324 and wrote off $5,000. We think that 2% of account receivable is uncollectible. Okay, well, how much is account receivable? Well, let's find out. So, T account, because that's the best way to do things. Account receivable. It says we had a beginning, there we go. We have a beginning balance of $18,000. We earned on account $447. We collected on account $324. That reduces our account receivable because customers paid us. We collected cash. We also wrote off $5,000. So this $5,000 I want to take off of my account receivable because I don't want it showing up on my balance sheet up here because I know I can't collect it. So it's not really an asset. So that's why I'm reducing my account receivable. So now I can calculate my balance. So we have $18,000 plus the $447 minus the $324 and minus the $5,000. So $136,000 is my balance in accounts receivable. I think 2% of that is going to be uncollectible. Okay, what's 2% of 136? 2720. Now here's what I'm going to do. I'm just going to write this 2720 down so that I can remember it. This is what I want to be the ending balance in my allowance account. Okay, here's my allowance for bad debts. What is in the allowance account? Well, it says assume we have an unadjusted 24 credit balance. Okay, 24 credit balance. I want this balance to be 2720, so this is what I want it to be. This is a 2. How do I get from 2400 to 2720? I need $320 if I did my math right. Let's just check. Yes, $320. This is my adjusting entry. The journal entry is going to be the same. It's just going to be a different amount. So here we are on December. And the amount that I calculated was $320. Because I already had some left over from last year. So I didn't need to expense the total amount that I think is uncollectible because I had left over from the previous period. Now part 2 says I have an unadjusted $2,000 debit balance. Okay. If I have a debit balance, allowance for bad debts, I have a $2,000 debit balance. This is a contra asset, so it has to have a credit ending balance. I want that credit ending balance to be 2720. How do I get from essentially negative 2,000, because this is a non-normal balance, to a positive 2720? I've got to put 2,000 in there to get it to 0, and then another 2720. So I need to credit 4720 to get to where I need to be. So now, does this make sense? 4720 minus 2,000 is 2720. It's the same. So now I'm putting in 4720. For the last type, aging of receivable, I'm saying I think that 4% of 75,000 is uncollectible, 24% of 3,000 is uncollectible. I'm going to calculate those amounts, add them up, and that'll be the amount that I want to be the ending balance in this allowance account, because it has something to do with receivable. If it is a percent of sales, the amount you calculate is the adjusting entry. If it has anything to do with receivable, the amount that you calculate needs to be the ending balance in your allowance account. I hope this makes sense. Let me know if you need anything else, okay?